Welcome to this discussion about Mercia Asset Management, which is listed on the AIM market of the London Stock Exchange. I'm Paul Bryant, the financials analyst at Equity Development. I've been covering the business for about 18 months now. It's a fascinating business, and I'm sure this discussion will be insightful for shareholders and potential shareholders. With me today is Mark Payton, Chief Executive of the business. Mark, thanks for your time.
Thank you.
Kicking off, you briefly summarize exactly what Mercia does, how it makes money, and what differentiates it from competitors.
Yeah, and that's probably worth stepping backwards at our origins, if you like.
Yeah.
So the origins were an observation, which I'm afraid still exists today, which is 21% of the high growth businesses out there are based in London. So domestically, 21% of those are based in London, and they attract 66% of all capital deployed into high growth businesses.
Right.
So there is a disconnect from opportunities outside of London and capital provision. And that really is what we set out 15 years ago. Actually, we've been on AIM 10, but 15 years ago to address that. And we started investing, 50,000, 200,000 into promising businesses, and we're now investing 5, 10 million plus into promising businesses. And 85% of what we do is outside of London. So London is important. It's an important centre for us and everybody else, but it's not the everything. So that's sort of that's what we do. But we set our stage out and we have a very clear purpose, which is frankly prosperity and wealth creation for all our stakeholders. And I often talk about stakeholders, and the stakeholders are, the companies and the projects and the opportunities we're backing. It's the funds that we manage on behalf of others. It's our employees, because they are our everything. And of course our shareholders. They're our stakeholders. So we're always aligned on that purpose, if you like, in that regard. And how we look to win, which I believe is our differentiation, is that we look at how do we source opportunities that others don't necessarily see. And we do that through physical presence. We have 11 offices across the UK. Right. And we do that with our people. We have 140 people across those offices, speaking with advisors, speaking with intermediaries, accessing those opportunities, building long-term relationships. And it's that access that we benefit from. And the final point, which has been personally really important for me, which really threads into culture of any organisation, we've grown from 3 people to those 140 people, are our core values. And we think the combination of that physical presence, our core values of growth, of trust, of responsible and responsive and connected. Those are our 5 core values. That operation gives us our ability to what we would argue is the way we win. And that's our differentiation. And we're very, very dear to those 5 principles to do that.
Right. And there's 2 distinct financial elements. You're providing equity and debt to companies. Can you tell us a little bit about how those 2 separate bits work?
Yeah, we look at our asset classes that we manage as adjacent asset classes. They're discrete and distinct, but they're adjacent. And so we started our life off as a venture capital provider. Yeah. So venture capital, half of our business, of the 2 billion that we have under management today, approximately 1 billion of that is in venture. So that's the first part of our business. And I think this is really important to show the discrete parts of what we do. The next bit is what I'd call development capital, and that's private equity and debt provision. And the third element is property finance. So those are the 3 bits which play to our distribution, in terms of sales and distribution, in terms of investors in our funds, as well as our deal origination. And then the piece that we've made a commitment to now move into is an adjacent to the property financing, which is real assets, affordable housing, social housing, that sort of area we're looking now to move into. Yeah. So those discrete areas are really important to us. They're adjacent in terms of our physical presence. They're adjacent in terms of the people that operate across those. And in terms of the capital amounts, as I said, venture is by far the largest part of our organisation. The other bits are growing up because the sort of total addressable market of where each of those fits in, we're just scratching the surface at the moment of those areas.
That leads us nicely into the growth potential of the business. So a key part of that is where Mercia sources the capital it deploys to those businesses. Can you tell us a little bit about where that comes from currently and how it might change over the next few years and longer term?
Yeah. I mean, at the heart of everything we do is sort of risk mitigation, whether it's for our clients, whether it's for our shareholders, and that is really to do with diversification as well. So diversification, whether it's those asset classes I just talked about, or actually the capital that we manage underneath that. And we manage 3 pools of capital. We manage retail through venture capital trusts, VCTs and EIS. We manage public sector capital, and that for us is predominantly British Business Bank.
Yeah.
And we manage institutional capital, whether that's local government pension schemes or further institutional capital. So those are our 3 pools of capital that we manage. And then those asset classes above, venture, development capital, property finance at the moment, those 3 areas are all in growth metrics. Okay, so and it's a very exciting. I think venture for the UK is a relatively new asset class compared to the other areas, and that is definitely in growth. And we may well get onto the Mansion House, etc. But that is pointing to private capital, and we only manage private capital, but it's a specific sort of drive into venture. And if you look at the sort of total addressable market of venture, there was about between 4 and 6 billion invested last year. And so in the full year, that's how much was invested. And we invested in the sort of the comparative year about 131 million. So if you were to say, okay, well, it's reasonable to go after 10%. Let's treat that as a 10% market share, so 400 to 600 million. We're doing 131. We can easily double our position. So with me, I look at venture and say, okay, how do we get our 1 billion to 2 billion while still delivering what our investors expect from us? We see the origination that supports that, and so we see the growth trajectory that supports that. You come on to development capital and you're in a sort of 5 to 10 billion type of market share, and we're absolutely just scratching the surface, less than 100 million being deployed there. So again, you can do the 10%, follow it down, huge growth opportunity. And then if you go into property finance, that's in the sort of 10 to 15 billion mark within our market segment. And again, we're investing less than 100 million in there. So again, you look the 10% flow through, plenty to go for there. So in terms of deal origination and opportunity, all of those markets are in growth, and we believe we can greatly grow into that. Then if you look at the capital sources below, retail, for us it's VCT and EIS, and EIS is typically sentiment driven, and that is a tough market at the moment. So I say EIS is a hard group market for all players in EIS. That's a struggle. So that market at the moment is fairly static, and one hopes that will grow, and some of the initiatives that have come from the recent autumn budget, for instance, may well help that.
Okay.
British Business Bank, that has got an increased amount of capital allocated to it. We like to think we are an effective and trusted partner, and we believe that there's much more growth from that source of capital to come for us being that partner in its delivery. And then institutional capital historically has been challenging, and we can talk about that maybe later on, but there are a number of initiatives trying to redirect that capital. We think that is a growth opportunity in the sort of medium to long term.
Okay, well let's dig into it now. When you say institutional capital, who is that? And how much could they move the needle? Could the 2 billion get to double, more?
Yeah, and one of our, as I said, our core values, one is growth, and I'm a great believer in you're shrinking or you're growing. There is no such thing as standing still. So you have to have a growth mindset when you're looking at all parts, whether it's our businesses we're backing, the projects we're backing, or ourselves as an asset manager. So within institutional capital, subsequent governments, so not just the existing government, have been trying to drive a peculiar dynamic. And that peculiar dynamic is if the UK was an asset manager, Mercia Asset Management, if the UK was an asset manager, there's about 9 trillion under management across the UK. That would make it the second largest asset manager globally behind the US. So quite impressive when you think about it. So okay. And then, so of that money, how much is deployed domestically? So the US, of their capital, they deploy about 60%. France and Germany, about 40%. Japan, 50%. Australia, approximately 45%. UK, less than 4%. So second largest asset manager, deploying less than 4% of that in the UK. And that really is behind what was initially the Mansion House Compact, became the Mansion House Accord, was to try and redirect more of that money domestically and redirect that money into the private markets, of which AIM, we're an AIM-listed business, is deemed to be a private market. So AIM is part of that philosophy. Can you point institutional capital? And what that institutional capital is predominantly DC, so defined contribution pension capital, it's insurance. So you have a number of parties that have signed up to the Accord, and we're talking to many of them actually, about a medium to long-term commitment to direct more capital into the private markets, into the domestic private markets. And that, I think, will be a catalyst of growth in the private markets and is an exciting tailwind that we're just on the edge of at the moment. And it's not being legislated, so it's really being seen as something, a request to move into. But I have been very pleasantly surprised by how that is moving at a pace now. And so I think that's good. That's good for the UK. It's good for the regions, and that's something we're really, really passionate about. And it's very good for the private markets too.
Right. So potential there for some big chunks of capital to come in.
There is. And always, and it's back to the very beginning of the purpose I was saying about, which is sort of wealth creation, prosperity, etc. It's always on the back of track record. These are people are saving money into their pensions for their own retirement and long-term returns. So they want to back managers with a track record of delivery. We've got, so for instance, we have a fund called the Evolution Fund, which we've done the first close in the second close. That's on the back of 2 other funds we've done before, operating at IRRs of between 12 and 15%. Very attractive, good return. It's those sorts of funds that institutional capital are it's a private fund going towards, because they can see how they're doing the right thing for their clients. And that's the important thing, is track record, managers that deliver against expectations.
Right. While we're on different types of funds, let's have a quick chat about VCTs. Now, the last budget, there were a few moving parts affecting VCTs. Can you talk us through that and what the future of your 3 VCTs looks like?
Yeah, I mean the whole, everybody was bracing themselves for the last autumn budget. So and we sort of watched with interest, and we saw actually a number of features going on within the autumn budget that was specific to our part of the market, not just the VCTs. So you had a sort of commitment by the government towards British Business Bank. British Business Bank, really important partner to us, but a really important provider of capital across the UK. So that's great to hear that sort of solid support. So that was the first positive thing we got out of that. And then they've got, back to what we manage, which is the the Enterprise Investment Scheme, Venture Capital Trust. So 2 distinct products. Now, EIS has got a structure which encourages capital growth. So it's to encourage individuals to put money into younger businesses, to grow those and benefit from a capital gain basis that is tax-free. And so it's risk, but there's a reward. And one of the challenges across both EIS and VCT is you've got these young businesses growing, and the rules that were set up were years ago. So now how much a young business needs to requires during venture growth is great. It's just much, much more. And yet you had a cap on how much you could put per annum and how much in total you can invest into these businesses. Right. And they changed the rule. That was, I think, a really important point, is they changed the rules so you can double the amount. You put 20 million per annum into these businesses, and now you can double the amount of their business life to 40 million. That's really important, and that's a great thing for EIS. And for EIS, that's what they did. There's no other changes. For VCTs, the investors in VCTs benefit also from tax-free dividends. That's right. Okay? So there's an additional benefit that EIS don't have. And so the government made the case and argued that we're going to lower the income tax benefit for investors in VCTs from 30% to 20% because they benefit from tax-free dividends. Now, you can argue whether that's valid or not, but that's the logic behind it. For us, we can now support businesses with more capital per annum and in total. So what that meant for us is that we went back out to the market. We were in the market raising 50 million, and the VCT boards have basically decided to increase that amount so that we can take advantage of these changing rules coming through and deploy more capital. Our take on these changes is firstly beneficial for investees, very good for investees, and secondly, it will create some turmoil in the VCT industry. And the reason why I say it will create some turmoil in the VCT industry is that not all VCT funds out there have the capital to be able to put 10, 20 million into an invested per annum. If you're raising 5, 8 million in a year, that rule doesn't help you. But you have the negative slant of the 30% to 20%. Gotcha. So our expectation is for the larger VCT operators, which we are one of them, this in the long term will be a positive change. But for the smaller operators, I think they'll struggle, actually. And so that's a concern because, I actually quite like competition. I like other managers operating in the market. And so that is a tangential concern. But from Mercia's perspective, it's a wholly positive way forwards. Yeah.
And interesting, the dilution of that tax sweetener did not impact your recent fundraising. I mean, you increased it.
Yeah. And the way way the announcements come through is basically until the end of this tax year, so 4th of April, you still benefit from the 30% income tax relief. Then after that, it's down to the 20%. And what we're awaiting is the Finance Act to come through later on in this year, where the rules will change and you can deploy more. So if you raise money in the next tax year, you're raising it on the 20% regime, revised regime, whereas if you raise it now, it's on the 30%.
Got you. Okay.
So there is a strong logic to raising more money now to the retail investors' benefit and taking advantage of the rules going forwards post that change. So I think that there's a strong logic for us. I expect next year there's going to be some changes in the industry, assuming the regimes stay static as they are now, because it's just there's a different logic into which manager would raise money. I also think it's still track record driven. I'm very proud of what the VCT team have done and the boards have done in their support in terms of the track record of delivery for our investors in those VCTs. So track record will be at the heart of any fundraise, as it quite rightly should be.
Yeah, interesting. So a space to watch. Yeah. We've spoken quite a lot about the growth and growth potential. So let's get on to that part of the strategy which now turns that into returns to shareholders. So talk to us about scaling, leverage, those kind of things.
Yeah, for a number who've been we have institutional investors who've been with us from the beginning. So we listed on AIM December 2014. And when we listed, the logic was a hybrid investment model.
Yes.
So we'd have managed funds and we would selectively invest from our balance sheet capital into businesses emerging from those, what we used to call emerging stars. And we build up our balance sheet investments, build an evergreen model, and we can recycle capital. And that was how we started our journey. Our asset management area, the funds under management, has performed very, very well and has broadened out through organic and acquisition. And the city's perception on private holdings versus the private market's perception on private holdings are poles apart now.
Yes.
So there's a degree of cynicism, and valid for some, when I look across at other managers, valid in some cases, but there's a degree of generic cynicism in terms of the value of a holding. And fundamentally, you can only demonstrate the value of a direct holding when you sell it.
Yeah.
That's a single point when you're, will you write or not? And historically, we've sold everything on our balance sheet above holding value. So we're confident in that. Yeah. However, there is cynicism, there's industry-wide cynicism, it's publicly known. So we made a commitment now, a little over a year and a half ago, to what we call the Mercia 27. And for Mercia 27, that was a commitment to really do what we're very good at, which is grow our private capital under management, our third-party funds under management, from what was 1.8 billion, and the target is 3 billion. So grow that. Grow the profitability of the group as well. We're a dividend-paying business.
Yes.
So grow the profitability of the business and service what we call a progressive dividend, and simplify the business. And by simplify, it means take that distraction, the direct investments away, by selling those down pragmatically over that 3-year period. And we made a commitment to sell up to 70% by value of that opening book value back over a year and a half ago now, and use that capital to fund our funds under management, to return capital back to our shareholders, and to make selective acquisitions with. Yeah. And that was a commitment we set out on, and is a commitment we're driving forwards. And this is the right thing for us to do as a listed business in the current environment.
Great. That's really useful. Let's dig into those direct investments a bit more, which sit on your balance sheet. Appreciate they're not part of the long-term plan anymore, but they're significant, particularly in terms of short and medium-term shareholder returns. I've emphasised in my research notes the share price is nowhere close to reflecting the value of those. The latest NAV is £125 million. The market cap of the entire business is only about 116 the last I looked. So one step at a time. Give us a short overview of what that portfolio consists of, the types of businesses and where they are in their life cycle.
Absolutely. So I'll give you a snapshot across some of them. I think contextually as well, I'm always a big fan of the context behind everything. So often being told, control what you can control and what you can't control. Try not to get defocused, try not to get distracted by it. We can't control the share price. And the share price is driven predominantly by a general capital outflow that's going on in AIM. So what we do is we focus on maximising value within Mercia, and the markets are the markets, and that's how it is. But the one thing to reassure markets is our balance sheet. And of course, we're not going to suddenly sell them all next week because we're not in fire sale territory. There is nothing on fire in our balance sheet. We are pragmatically developing those through to exit. Our balance sheet assets have all been, we have advisors, sector advisors across them all. We know those value inflection points, what we're trying to get those through. So what we are going to do going forwards through regulatory and through general sort of public awareness is shine a spotlight on each of these assets that are developing through, because we've got some very high profile businesses coming through, whether it's Medherent with its testosterone patch, where it's under development and under delivery through clinical trials at the moment, whether it's Warwick Acoustics for its fantastic flat speaker technology, which is integrated into an automotive, which we hope to be sharing the name of that automotive in the coming period, short period.
Okay,
so that will be coming through, whether it's VoxPopMe, our video analytics business in revenue growth with a very sophisticated AI engine built into that. There is a multitude of different businesses going across, and what we have to do is not just sell them, because of course we're going to do that, but tell people out there what they're about, so people can understand why we believe the holding value is right and maybe others don't. So there's an education in that regard. But in terms of our portfolio, we've got about 20 direct investments. Right. We've not been adding new direct investments now for quite some years. So it's a focused portfolio in that regard. Of those 20, about 80% of the total portfolio value is captured in the top 10. So clearly those top 10 are really important. And within the top 10 are names I've just mentioned. Yeah. So they sit within the top 10. There are others that will be driving value through. But that is the main focus within our efforts in terms of value realisation, is those top 10.
Right. And Mark, what's the exit environment like at the minute? What would those exits look like, and how are you working with management to engineer those exits?
Yeah. So when we set out on this strategic plan, this 3-year plan, we spoke to co-investors, we spoke to management, so we had to make sure there was an alignment here, because you don't want to force a sale. You want a pragmatic realisation from this, and you're looking at a sort of value maximisation. I mean, our commitment to the market is, look, the holding value will realise from that. But I would like to think that Warwick Acoustics will go for much more than the holding value, for instance, because it's a very exciting asset. So we are aligned in that regard with all. We're absolutely all. And back to that sort of beginning purpose, this is about wealth creation and prosperity, and for all our stakeholders, which includes our funds and our balance sheet. Now, if you look at our direct investments, almost all of those have fund investments alongside them because they have originated from the funds.
Right.
So that alignment is really, really critical. And so we're quite proud of that. And we have within our venture portfolio, we sit on the boards of them all. We have a very strong relationship with our co-funders and with the management teams that are driving those, who are frankly working 24/7 to maximise value in those businesses. And that's important for us because a lot of the investments we make are into repeat entrepreneurs, into NEDs that we sit on the board. So behaviour is really important in our game. So we have full alignment. We're moving those through. In terms of the exit environment, the notable thing is the IPO market is very subdued. Yeah. I mean, very subdued. And we often hear in the press about the public markets are going gangbusters. Look at the FTSE 100. FTSE 100 is a sort of global index of what's going on. Go below that. Look at the small cap market. And the small cap market, whether it's on the main market, whether it's on AIM, is struggling. And therefore, the attractiveness for an entrepreneur to take a business onto what would be a suppressed valuation is less interesting. So what we're finding with our venture businesses that occupy in the private markets is that we've got secondaries, we've got larger funds that are taking positions out in them, and we have trade sales, which are predominantly overseas corporates. Right. And so, stepping back in my own personal passion, which is to get the UK working region by region and to keep businesses here and to grow them, then we need a public market functioning. We need the small cap market functioning. And so that is a piece that until that starts working, our exits are driven by secondaries and by private sales, whether we like it or not. Yeah. And that environment at the moment is still actually very buoyant. The one feature that's happening in that market is transactions are just taking longer. So exits take longer, engagement with acquirers takes longer, the whole process is lengthened, and that's not a Mercia, that's an industry-wide perspective at the moment, is both transactions in terms of getting into these businesses and in terms of getting out of the businesses takes longer.
Yeah. Last one on the direct investments. You touched on the exit track record in terms of valuation. That's the easy answer on how you value these, and what's the potential for that to be too aggressive or too conservative even?
Not too aggressive, because that is the one thing you'll get absolutely burnt with. But there's a real balancing act, because you can't also be too conservative. Because it's not, especially as a listed business.
Yeah.
Within the private context, less of an issue, because you don't have the dynamic of buyers and sellers always going on. You've got your LPs locked in a long-term fund. If you've got the valuation wrong or right at any one point, it will correct through. And if you don't deliver the returns that they expect, that's your last fund you're managing on their behalf.
Right, yeah.
So within the private market, it's a slightly different dynamic. Within the public market, you have to get the valuation right, because if it's undervalued, then you're selling short of the existing shareholders when new ones are coming in. And if it's overvalued, you have the polar opposite challenge. Yeah. And we follow very clear regulations in terms of the International Private Equity Valuation Guidelines. Very clear sort of draw on how you value these businesses, often through multiple metrics, in terms of trading fundamentals, in terms of comparators, etc. And we do independent valuations. And I think the other thing is, although we don't need to, we have our balance sheet portfolio audited every 6 months. So a third-party adjudicator, if you like, will look across those and determine whether we're right or not, and will report publicly against, we think you've overdone this or you've underdone that, and it's all in the public domain, and people can see what third-party auditors think about that. I think that's a really important metric. Ultimately, it's whatever you sell it for is what the value is, and what we have to do is make sure it's the right value.
That's really useful, thank you. You mentioned earlier you are looking for a move into what you call the real assets space, probably through an acquisition. Tell us exactly what that means and why it fits into the Mercia strategy.
And I think the acquisition piece of Mercia is really important to first start at. And we have a team within Mercia that sort of leads the acquisition approach. Martin Glanfield, Mercia's CFO, is absolutely at the front of that. Yeah. And what we're doing is, the first point is, the acquisition compresses time. So if we're here and we want to get there, can we get there faster? And if so, what out there could help us get there? And usually that means, so if I use the journey of the acquisitions, because we've done 3 over the last 10 years. First one was we set up in the Midlands and we wanted to grow. And we knew that British Business Bank was bringing its first generation of funds through, and we didn't manage any of them. So what do? Enterprise Ventures, dominant provider of debt and of venture capital across the north of England, a backer of previous British Business Bank funds, perfect fit. And the combination of those two businesses, and many of the Enterprise Ventures team are still with us today, combination of those two businesses meant we went from the Midlands to Midlands and the north of England. Right. And we went from small amount of venture to venture and debt, and we went from no relationship with British Business Bank to a firm relationship with British Business Bank. So the second acquisition, then you lean to, okay, well now we can write checks from typically 100,000 to maybe 1 million or 2. Mm-hmm. How do we get into the next, if we believe in a business, how do we carry on providing that capital? Yeah. So the next point was, well, who is out there providing these forms of capital? And what fits with our ethos about, it's not just about finding the best in London, but maybe in Newcastle or maybe in Manchester. How do we fit with that philosophy? And the VCTs that we were just talking about, perfect, because you can write bigger checks into that. Yeah. And there's a requirement. I mean, the reason why these have tax incentives is they are addressing market failures. And so there is a requirement to find those businesses that historically struggle to find capital to meet that demand. And that means now we can write much bigger checks into venture. So then the next bit with that same philosophy is debt. We're writing relatively small checks into debt. How can we build that out? And actually, we quite like the look of property. How do we move into that roll forward to FDC? Now we're writing much larger checks in debt, so we can do that beginning bit all the way through, and we move into property finance, which is sort of an adjacent piece, still lending money, but now to developers rather than to SMEs, if you like. Yeah. And then the logical route now is, okay, we're lending money to developers. How do we actually move into ownership of those assets? How do we move into, and I think it's difficult to read the press or hear on the radio, there is a huge demand for affordable housing in this country, quite rightly so. Anybody who's got children will know this, quite rightly so, there's a demand for that. So you have a market pull, back to Mansion House, and you have a market push, trying to get into capital and trying to provide capital domestically, and you have a governmental and you have a regional government, you have very vocal mayors. Everybody is crying out for more affordable housing. that is our next logical step to move into that market sphere. And the best way of doing that, just from the previous three, is acquire into something you're familiar with, but bring the capability and expertise in. And that will be an area we are exploring at the moment.
Right, useful, thank you. Last one. Investors obviously track the financial metrics of the business through the statements and stuff. Any other metrics you disclose which could be really useful for shareholders or potential shareholders in terms of, right, this is on track, it's going where it is, etc.?
I mean, I talk to as you'd expect, talk to a lot of my peer group chief execs, but I also talk to other industries chief execs. You compare. Very often there are similar things going on, drivers in different industries, and the one big driver is, and there's no escaping from it, the cost of doing business has gone up, and it's not going down. So therefore, you've got shareholder expectations in terms of returns, but yet your cost base, whether it's people costs, whatever is going up. And the only solution to that, from the press's perspective, is take people out of your business. But that's not true. Back to the growth, the solution is productivity and efficiency, so you can scale your business at a rate faster than you need to add people to it. And the good leaders out there is exactly what they're focused on. The people who are taking swathes of costs out of their business now, I get it before, but now, when you have technical solutions, and AI is talked a lot, but actually for us, AI is an efficiency, productivity tool. There are things going on in every business that is manual, that actually people don't like doing, and would much rather be doing something over here, but they don't have the time to do it, where you can take time out by using them. And we're doing that. We have sort of incentives, and we're empowering many of the team members to start to use sort of digital agents, whether AI or otherwise, automation. And it's amazing. I mean, it's absolutely remarkable. And we're just scratching the surface. So in terms of metrics to measure, it's, AUM per employee. So how do you grow your assets under management without growing your employee base? So AUM per employee is a really good way. EBITDA margin. So how do you grow the profitability of the group without chucking in additional costs? And cost is always people. So those are metrics for us internally are really important. We have a really, really strong leadership team within Mercia, which is the executive committee. And we have a bunch of drivers and metrics that we're all measuring, because we're sort of standing, alignment is so important in every aspect. We're all standing and facing the same direction, which is we want to scale this group, but we want to scale it in a productive and efficient way that makes sense for all of our stakeholders. And it's that back to that vision about being first choice. It's all of those. How can you do it? And I think systems, policies, processes are a really good way of that next step.
Great stuff. Thank you, Mark. Mark, really useful insights. Thank you so much. For those looking for more information, I'd point you to the Mercia website at mercia.co.uk. And you can find Equity Development's research, which includes forecasts and valuations, at equitydevelopment.co.uk. Thank you very much.